Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jader Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Shannon Robnett, and for the last 40 years, he lived in Boise, Idaho. He's been building and developing there for over 25 years. And 2 years ago, he moved to Puerto Rico for tax purposes, but still has 3 companies in Boise. And in just a minute, we're going to speak with Shannon about the benefits of new multifamily ground-up construction. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple of things you can do. You can like, share, and subscribe. And as always, we would encourage you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Shannon. Welcome to CRE PN Radio.
Thanks, Darren. I'm glad to be here.
Well, I'm so glad you could join us today, and I'm looking forward to our conversation. Before we get started, if you could share with the listeners a little bit about your background.
Sure. So, Darren, I grew up in a construction and development family. My dad was a general contractor. My mom was a third-generation realtor. I had my license for a period of time, and I've got a 24-year-old son who is in real estate as well. And that's just kind of how I grew up. I just always, I looked at it growing up when I was always working with my dad and working on stuff and cleaning up job sites. As I didn't really see it as an internship then, but it really turned out to be the backbone of what my experience has been from there. And I just saw, I was working on a job site for my dad, and I got to know the crane operator, and he was complaining about he didn't have anywhere to put his stuff. And I got to know the little old lady next door, and she was looking to sell her place and go to a nursing home. And all of a sudden the light went on, and I didn't take my last $500, Darren. It was my only $500. I mean, I was nouveau broke, man. I just decided I was moving out of my parents' house. I had no money. I got that property under contract contingent on getting it rezoned with the city. I did just that, and I sold it to the crane operator, and I made about double what I was making for my dad working that whole year on a $500 investment. And from then, I had no choice. I had to be hooked, right? I mean, I was in.
Yeah. No, that's awesome. And like you said, kind of a unique, kind of a lifetime internship. You get the both ends there from your parents and being around it. That's awesome. So let's talk a little bit about what you're doing now. You are now in Puerto Rico. You were in Boise, and you've still got some companies in Boise. What are you doing in Boise?
Yeah, so Puerto Rico is, they've got a great program here. It's called Act 2022, that if you're spending 183 days outside of the continental United States and or in Puerto Rico, you create a residency here that changes your tax status. But I didn't want to give up my companies in Idaho because after 25 years of building and developing there, I was just getting going. Things were just starting to get going very well. But as we've all figured out with COVID, you don't actually have to be there every day, all day long to get the same things going if you've got great people in place. So I was doing Zoom calls 2 years ago, and everybody thought I was just this really cutting edge contractor, right? I mean, that's almost like the biggest oxymoron out there, cutting edge contractor, right? Because we were doing Zoom calls and we were this and we were that, and I could only meet on certain times of the week when I was back in Idaho. But the reality was I just kept everything going, and I have people that have been with me that are great people that can handle things day to day, and I'm in the development phase of things. So as a development company, we're building our own product ground up, whether that's multifamily or industrial. And then we kick it over to our own property management company that doesn't really act like a property management company. It acts more like an asset management company who's more concerned about your NOI because they know what the NOI does when you do it for development property or for investment property. Commercial real estate functions everything off of a cap rate. And without that, without being really cognizant of your NOI, you're likely to get yourself in trouble a little bit by just having a property management company that's just managing the tenants.
No, I couldn't agree more. If the property manager, and I think some of the best property managers I've gotten to know or understand that their philosophy is they try and keep the property ready for you to sell at any time, and it's both physical, but also on all the financial stuff, and that collecting rent and all that. But they recognize that the value is in that NOI, and so that's well said.
Yeah, something as simple as just turnover, managing your turnover better. When you're looking at a property management company, a lot of times they're concerned with the fees because they get a higher fee for a new tenant. So they're going to take the 15-day vacancy. You're going to clean it. You're not going to, your security deposit's not going to cover. Maybe you've got to replace carpet in between tenants. And those kind of things cost money and they affect the NOI in a huge way.
Yeah, no, exactly. So let's talk a little bit about your approach. I think a lot of the people I've talked to or had the opportunity to talk to on this podcast have been multifamily investors, or in some way, shape, whether they're investing directly themselves as a passive investor or they're syndicating. And I think by and large, a lot of the energy is to get in and get out. To find something that's has room in it, whether it's old and tired, maybe it's poorly managed, but do some sort of a value add, and then upon the increase in the value, liquidate and pay everybody, and then move on to the next one. The fact that you're starting from new construction, is your long-term objective, is it more of a build and hold, or are you building and selling the finished product?
Well, Darren, I built my first building to own for myself at 28 years old, and I didn't know anything about cap rates at the time. And so once I'd filled the building, I had somebody come and offer me 25% more than it cost me to build it for the building with the tenants in there. I look back on that building that I sold back in 2001, and 3 of the 6 tenants are still there, right? I mean, you got a guy that rebuilds fuel injectors. You got a gelato ice cream guy. I mean, just salt of the earth people that have businesses to run. And so I've looked at that and I've said, well, what kind of investor are you really encountering, right? And I think that you're finding 2 basic kinds of investors. There's those that want to hold on to the asset because they want the cash flow. And there's those that want the growth on their money and they're looking for the fastest way to get there. And I think what happens a lot of times is we try to put those 2 together in the same syndication or the same partnership, and you're trying to accomplish 2 different objectives. So we have a couple of different strategies that we use with our ground up that fit more the investor. So if you're looking for growth and strictly growth, we have that. If you're looking for some value add where you want to get in on a deal, we're going to build a building, we're going to build some multifamily, we're going to stabilize it, we're going to do a refinance, we're going to hold on to it. We can do that too. We have that strategy. But what we find that is a lot of times when people really come down to it and they realize that they can make between 25 and 35% with our growth strategy, where we build it and we liquidate it, they realize that they don't want to hold that for 5 to 7 years because it marginally improves from there. But the main value, like you said before we started the show, the original value add was the ground up development, putting the sticks and stones together, creating the value by putting the tenant in and creating that cash flow and liquidating at that point as soon as you can, because the sooner you can get your 25% return, the better that looks. Because if it takes you 8 months to do it versus 12 months to do it versus 16 months to do it, you're still getting a 25% return, but your IRR or your return for the year is substantially affected by the duration of time.
No, that's so true. I know there's a property I've got, and I was looking at it and thinking like, wow, we've done so well. If you divide by the hold time, That's a pretty impressive return, And then if you start thinking like, well, what if we hold it another year or do this and the returns are marginal. I mean, they really, it's kind of a fast hit and, turn is, I guess, the optimal. I guess you get that money back working into another opportunity kind of thing.
Yeah.
And, but I think like you said, there's essentially two classes of investors: those that are looking for a steady return versus those that are looking for an equity boost. Um, and let me ask you, because you being in Puerto Rico, I mean, most of the people I know that are doing the, um, like the syndication with the kind of the quick value add and return. Once you distribute that money, and because you're in a syndication, my understanding is that most aren't able to take advantage of a 1031. It's basically it's similar to like a stock return from the standpoint of you buy, you sell, you pay your tax, you move on, kind of a thing. Are you being set up in Puerto Rico? Are you subject to those taxes, or is that?
Well, the reality is that the IRS says that where the money is made is where it's subject to be taxed. So, but let's go back to your question though. I mean, we've all heard the adage that the money is made on the buy. You don't make money when you sell, you make money when you buy. And that couldn't be truer in what we do, because it's not necessarily when you buy, but how you buy. So if you know that you're going to be in and out of this deal and it's going to come to you as ordinary income, what's the safest way to do that without paying taxes? Well, use a self-directed IRA, right? Whether it's a traditional or non-conforming IRA, use a self-directed IRA so that your returns go straight back into your IRA, and you're not subject to the tax penalties that you would face if you made that 35% and then turned around and had to pay Uncle Sam, right? The other reality is, I mean, if all you're doing is holding on to something for a period of time to avoid the tax today, the tax bill is going to come due at some point, right? So, I mean, we all get caught up in the fact that, no, I got to do it. I got to do a 1031. But Darren, you know how to do basic math. If you're getting a 35% return this year and next year you're getting a 6 cap, that's a 6% return, right? You average those two together, you just torpedoed your return. Was it really worth that to not pay Uncle Sam a little bit of money, or not think about some advanced tax strategies before you purchase?
Right. No, I think what I've kind of resigned myself to, as far as um, the conversation in the line, I think it's a hold time. If you're planning on holding, if you have held something for a long time and you've depreciated it down to almost nothing, your motivation to do an exchange is probably greater than if you've got something that's you've got a pile of cash you want to put to work, and it's not encumbered by any kind of real estate, or it's not subject to any kind of a gain. I mean, you're looking to put it to work. To me, it makes more sense to kind of keep that working faster. But I think where I've gotten, and this is a lot of self analysis kind of thing, is recognizing that a lot of the properties I've got, I've had them for a long time, and it's either, I would need something just, I guess I need to sit down and really go through it, but I guess I've just felt like I've gone past the line of demarcation of easy in, easy out based on the hold time and the depreciation schedules.
Well, then there's also the opportunity zone stuff, right? I mean, there's some great opportunity zone opportunities that we're dealing with in Idaho, that are brand new product in a great area, whether that's multifamily, whether that's industrial. But opportunity zone provides for that. You do pay the tax, but you pay the tax in 6 years from today.
Right. And if you
then
hold long
after
enough,
that,
you get the gain, you get the
the
gains
gain is
free.
tax free.
Yeah.
Right. If you hold it for 10 years. And so we're doing a couple of those projects yet this year, where you're coming into the opportunity zone, you're getting about a 16% cash on cash. You get that for about 6 years. That pays about 65 or 70% of the taxes you would owe. We're also doing a cash out refi at the end of year one with stabilization. So you're getting a return of most of your money anyway. But just like anything, the IRS believes that when you bought $100,000 of a syndication and you refinanced it, it doesn't matter to the IRS, right? It's just like refinancing something that you've depreciated out. They don't care how far you've depreciated it. They're still looking at it that you have $100,000 investment in there. So
Right.
you're now deferring that into that program, into the opportunity zone. And then when you're extracting your funds at the end of that 10-year period, you've essentially washed them. You paid for your sins of depreciation, right? You've done that in year 7, and now you're off to capture your gains again without taxes.
No, that makes a lot of sense. And again, utilizing one of those unique structures available right now, the what is it? The opportunity zones, right?
Opportunity zones, yeah.
Qualified opportunity zones.
Yeah.
So, well, let me ask you. So, your primary territory of building is it Boise? Is that where you?
Yeah.
You do all
I've
your,
spent 40 years there. I know the Valley well. If you look at the last 5 years in Idaho, last 7 years in Idaho, we've hit about every top 10 list there is. So I've got a really target rich environment. I've got a portfolio of about 1,000 doors and about 150,000 square feet of industrial to build in the next 3 years. I really don't have to look outside of my immediate area. Plus, I got to admit, Darren, I'm not that smart. I can't learn the demographics of Tallahassee. Meanwhile, trying to figure out what's going on in Kansas City and look at another deal over in Santa Monica, California. It's just beyond my capacity to understand those markets. So I can do what I do right where I'm at. I can get fantastic returns for myself and my investors. And we get to stay in an environment that I work in and live in. I know I've got subcontractor relationships that are 2 decades old. I mean, I've got everything I need. And it puts me in a position where I'm not trying to learn a new market and move in other areas.
well, I think you touched on there, just having the relationships. I mean, knowing the area and having the people you can count on to get the job done.
Right.
That's huge. That's great. So, and you said you have 1,000 doors plus industrial space, is it?
Yeah.
Okay. And are those a long-term kind of portfolio, or is that more
We've
like
got,
just a
we've got,
mix of?
like I said, we've got some that's opportunity zone that we're holding for a minimum of 10 years. We've got
Yeah.
some other stuff that we're going to hold for about 5. We've got some other stuff that we're building and selling immediately, creating a liquidity about on that. So we've got just about something for everybody. It just really depends on, but then again, back to your statement, the original value add was new construction. So if we've made the majority of the money in the first 12 months, why would we continue to hang on to it?
Right.
I mean, it's not like we're in New Jersey where there's not much ground left to build new. We're not like a lot of value add syndicators that are stuck looking for the next deal that fits their parameters, because I can create a brand new deal tomorrow with the property next door or the property down the street or the property 3 blocks over, 5 miles away. We can just create another one.
And what are the current growth estimates for Boise? Is it? I mean, everything I've heard, it's like you said, it's red hot. But is it a lot of industry coming in there? Or?
Yeah, we've got. I mean, we're seeing a lot of jobs move in there. We're seeing a lot of people move in for quality of life. We're seeing a huge retirement community move in. So we're really seeing across the gamut people looking for an affordable, safe environment to live and work in. And so, I just saw some stats from a realtor friend of mine that came across today that showed that we are anywhere from 15 to 25% appreciation in home prices so far this year across the valley. We've seen an 11% appreciation in number of units closed, and we've seen a 73% reduction in inventory. So we have, I mean, I don't know how else to qualify it red hot, but that's pretty red hot. In one of the biggest worldwide health crisis, we're having people flood to our area because we check a lot of those boxes. I mean, listen, San Francisco is a great place to live, but being in lockdown with 9 million of your closest friends isn't everybody's dream boat.
Right. No, I think a lot of the I don't want to say rural, but more where there's room operate. I think it'd become
Urban area.
definitely a lot more appealing.
Yeah.
I know of people that I familiar with that have, like, even in New York City, have sought out upstate, more resorty slash rural kind of areas to have a kind of a vacation home, or even and just even with all of the cost of living, and a lot of the employers have basically realized the cost savings by having their workers work remote. They've kind of given the employees the green light to relocate to wherever they want, and a lot of are looking for a lower cost of living. Uh, and I would think that Boise would certainly be a little bit more cost effective than, or cost efficient than, a coastal
Yeah. Well,
city.
even Darren, look at the conversation we're having, right?
Hmm.
You would be really hard pressed to be farther apart in the United States, other than you being in Alaska, to have this conversation. Yet we're talking like we're right next door to each other, and that wasn't available 5 years ago, right? So the whole concept of having to show up for work, I think, is a thing of the past, and you're going to see that in multifamily. You're going to see, we're already looking at changing some of our floor plans to accommodate work from home situations. In our complexes, we've already done that to a large degree in our clubhouse settings, but we're really seeing where, as a nation, we're able to unplug. I mean, if you're working at a tire shop, or you're working at a lumber mill, you're working at a restaurant, you're not going to be able to call it in, right? But
Right.
but by and large, I mean, you're in insurance. You can do most of what you're doing right here in your living room, and we can do that. So as we see that happen, I think you're going to see a lot of the benefit of being in Silicon Valley fade. A lot of benefit of being in New York in the financial industry, that's going to fade. You're going to be able to do the same thing from Kansas, from Dallas, Texas, from Boise, Idaho.
Yeah, no, I think that a lot of those metro areas, as far as the commercial real estate, there's going to be a pretty big reset on valuations and that, and that's kind of the cycle of things. So
Right.
I hope you got in on the right side, and got out before or you're prepared to ride it through. I mean, the cycle will happen again. I mean, these things
Right.
kind of have their way. So let's talk a little bit about just the strategies that you look for uh, when you're working with prospective investors, and you mentioned the IRA accounts. Is that primarily the source of the capital that you found to be most available and willing to go forward and invest with you, or?
In our growth scenarios, for sure. In our opportunity zones, we got people that are looking at it going, you know what, who knows what's going to happen when this election's finally over. I mean, we don't even know. It's not even over at this point, but if the 1031 doesn't go away, is now the time to maybe cash in on some of that? I mean, capital gains is capital gains, right? But there's a lot of people that did very well in the stock market that are selling that out, that are moving into a capital gains situation, and they're looking at it going, hey, if I cash out now, I can put that capital gains into an opportunity zone, and I can have that benefit of being able to defer that out and not pay the taxes on that for 7 years. So for us, our biggest thing, Darren, is to sit down with people that want to be an investor, okay? And to make sure that what they want to do, we are using the most tax advantaged situation and scenario to do that, so that we don't wind up in a situation where, hey, we made you a 30% return, but Uncle Sam's swinging in for his 37% of that. We want to make sure that we're doing things right. We're doing things in a fantastic version of the slimmest tax consequences we can do for you, to make sure that you're getting your needs met, and you're making your return the best it can be in an after tax calculation. So if you've got an IRA sitting around doing nothing, it's a Roth from your job from 5 years ago, and it's just sitting there, you don't even know what to do, it's in a mutual fund, let's convert that to a self-directed. If you're in a situation where you can put funds away in a non-qualified IRA, let's do that. And let's use those funds, because at least they went in tax paid, And now we're going to invest them in real estate. It's going to grow. You're going to be tax deferred to when you come out of real estate, but you're growing it without having to cut off a big chunk of it for Uncle Sam every time. And so I think, Darren, it's more about sitting down with people and finding out what they want to do and what avenues and funds they have available. We got people that we use their whole life policies, borrow against those to put into real estate deals, right? So we're able to use just about any source of funds that benefit our client the best that we can figure out how to do to create the scenario that's optimal for them.
Got it. So let me ask you this: for your development schedule, you'd mentioned a couple different time frames, 9, 12, 18 months. Are you doing traditional financing and just raising the capital for the down payment, or are you raising for the entire project, or how are you structuring your capital?
Yeah, well, as you know, the bank is a great partner, but they don't like to cover all of it, right? I mean, if you can pay a 1% loan origination fee and 6.5% interest on a construction loan, that's going to be much cheaper than involving 100% equity. So what we do in a typical situation, let's talk about this 36 units that we're midway through in Nampa, Idaho. The total cost of that was $5.3 million. The appraisal from December of 19 came in at $6.3 million. I went to the bank. The bank said, we'll loan you $3.7 million. So you got to come up with $1.8 million to do this deal. So I went out to LPs. I raised $1.5 million, and for that, I gave them 35% of the profits. So I was bringing $250,000 of my own money to the table. We are building the project. We've already received several unsolicited offers on the project at closer to $7 million than $6 million. And we will be able to liquidate that thing. And out of that, the investors will reap the return, but we used leverage, right? We used 60% from the bank. We used the rest of it from the LPs and myself. Just depends on what the situation is. But typically on a construction deal, you're getting between 60 and 65% loan to cost on your original construction. So you have to bring in a little bit more liquidity from your LPs on the upside. But I don't think it's really any more than if you bought the apartment complex with an 85% loan to value and then put in another 20% in your value add, in your CapEx that gets dispersed, changing it from the Oasis to the Three Palms or, something like that.
Right. No, new tile and grout.
Yeah.
No, so, but I think the one of the things that isn't always recognized, if you're at the front end of just looking at an investment opportunity and you're thinking about the value add, because the value add strategy makes complete sense. You can, if you got something that's undervalued, you can put a little bit in, and based on, the metrics of the cap rate, you can increase the value exponentially and, reap the rewards upon sale. But what that doesn't account for, I mean, just on the philosophy, is a lot of times a lot of the value add strategies are more about the high polished finishes that you can charge more for. They don't always account for the behind the walls and the things that are supposed to work, the systems that haven't been touched and nobody accounted for. And oh, by the way, you've got some electrical issues because the boxes are outdated, or the waistline is crumbling or backing up, or just all those system things. Where new construction, there's none of that. I mean, it's new. It's exactly what the buyer that's coming after you wants.
Yeah, and I think that reflects in our projections, right? So when you're doing a value add, anything that's over 15 years old, you're probably estimating somewhere between 45 and 50% expensive, right? In new construction, we're somewhere between 31 and 36%, right? We're putting away $250 per door a year because we know that 10 years from now, we may have heating and air issues. But we don't have to worry about a tree root growing through the sewer line. We don't have to worry about, that PEX pipe that they used a lot of in the 90s that likes to blow apart in the middle of the night. We don't need to worry about the mold that's growing behind the sheetrock that we never knew about. Those are the things that we don't have to deal with. And so the reality is, when you're looking at that second group that just want the cash on cash, and they're willing to take a little bit lower return if they know that there are no moving parts, again, that's where brand new becomes their drug of choice, because they're able to look at it and go, great, I got all the high polished finishes, I've got the brand new floor plans, I've got the granite countertops, I've got everything I wanted, plus I know it's new, so we're not going to have major expenses that are going to interfere with my cash flow in the next 5 years.
Yeah. No, and even even with that, I mean, worst case scenario, for whatever reason, the market got saturated, or there was it wasn't as appealing of a sale opportunity, and you had to hold it. It's not your repairs aren't going to be unexpected, or eat you up, kind of thing, which is, I think, the flip side of the whole
Correct.
buy and hold.
Yeah, you're very right, Darren. You're very right.
So, well, you've certainly made the case for new construction, and the self-directed IRA. If you're going into that kind of investment as an LP and you've got debt on it, is there any kind of penalty for using the is it unrelated debt finance income,
Well,
or
but see, since you're never part of the debt solution as an LP, you're not signing for any of the debt. It's never your concern. You're
okay,
strictly putting in your 100,000 or your 50,000 or whatever it is you're putting in. That's your only contribution to it, and for that you're exchanging that for shares that are of the full value of that initial deposit. So none of that plays in really, and so it's just a straight exchange.
gotcha. All right. And as far as your projects going in Boise, you've got a bunch lined up, or what's 2021 looking like for you?
We've got 191 units that will start before the end of the year. We've got about 40,000 square feet of industrial that will start before the end of the year. And then next year, 2021, looks just as full as this year. We've got about 400 doors to build, and about 100,000 square feet of industrial to take care of in 2021. So we've got a pretty full calendar already, and we haven't even got there yet.
That's awesome. And with that, what kind of a lead time do you anticipate for a project like that? Just to know that you've got, your 2021 calendar lined up. How long have you been working on those?
Well, the reality is, Darren, because I am not seller dependent, right? I mean, I am to some degree, but I'm buying the land. So some of my projects take some entitlement work. So there's 6 to 9 months in entitlement work. So I have a longer lead time than most syndicators have, because this deal hit the market on Wednesday. We've got to get our offer in. Then there's a highest and best. We go to the second round, 2 weeks. We know if we got the deal, then we got to close in 60 days. All that craziness that happens with normal syndication, none of that happens with us, right? So we had a building that went under contract last week that left us with a little bit more capital than we thought. So we went out and we bought another lot. We're going to do another syndication, another 25,000 square feet of industrial warehouse that'll come online before the end of the year, and it's that simple. So we're more of we're not at the mercy of what's going on out there in what's available for sale that's already built. So we're not as herky jerky as what a lot of people have to deal with, where they're making $100,000 commitments from their LPs in a very short period of time. I hope you like it. If you don't, we haven't seen anything in 6 months. We don't know when we'll see another deal. Buy something of mine. I'll put another deal together in another 2 weeks. It's pretty simple where I'm at.
I love it. Curious, you mentioned 2 projects. You said you've got one currently 36 doors, and you've got another one 191, and then it sounds like 400 doors in 2021. Is there like a sweet spot as far as the size of project that you found that you really like?
If I'm going to hold it, I'm looking for something over 150 doors just from a management standpoint. But the reality is there's a lot of people out there that are looking for that 20, 30, 40 door size, because that's small enough that they can self-manage. And so it really, again, just comes into what kind of scenario are we doing? Are we doing a build and hold? Then we're going to want something around 200 doors. If we're just doing a build to liquidate, build to sell, yeah, we'll probably do the 36, 40 unit infill projects and just build them out, stabilize them, and then sell those off.
Gotcha. Hey, Shannon, if we could, I'd like to shift gears here for a second. As I mentioned before we started, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically work on and try out. And the first is we ask, can we avoid the risk? If that's not an option, we look to see if we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation, whether it be their investments, their clients, investors, tenants, the market, et cetera, and identify what you consider to be the biggest risk. And for clarity, I just want to make sure we understand that I'm not necessarily looking for an insurance related answer. But if you're willing, I'd like to ask you, Shannon Robnett, what is the biggest risk?
I think in my business, the biggest risk is having the wrong people in the right places. You talk about risk transfer. I've always found that when I'm looking for a property management solution, I need something that's customized to me, that is looking after my property like it's an asset. And so I could do that, and I could make that happen, and I could become a pseudo property manager. But why not go find the best property manager in the valley that I've always admired and wanted to hire? And why don't I hire him and make him an offer he can't refuse to make my machine run smoothly and take that risk out of it? Now I know that I have somebody that's tied to the bottom line, that's financially responsible to me for the well management of our assets, that's doing it in a phenomenal way. And I've done that in several key places in my business. And I think that when you aren't taking care of your people, when you're not looking at the personnel you have, I think you're taking some pretty big risks. And so having great people that are in it to win it, that are part of your team, I think is the biggest way to mitigate that risk. And the biggest way to ensure that you're going to be successful is because you're partnered with the right people, you're working with the right people, and you've hired the right people.
No, it's well said. The human capital, it's part of the equation that if you're not paying attention to, you're going to spend. I mean, you can spend a lot of time training and retraining and blaming others and all that. But if you have the right people, everything seems to work pretty well. That's good.
And it's funny, most people that lose good people, they don't lose them over money. There's an underlying issue that's in there, that if you're paying attention to your people and you're rewarding them in the way that they're looking to be rewarded, you're always going to find that you're able to keep good help, because not everybody's looking for the bottom line being the money.
Yeah, that's so true. Shannon, where can the listeners go if they'd like to learn more or connect with you?
Sure, Darren. So the easiest place to find us is at shannonrobnettindustries.com. We've got a great website there that'll hook you up with all of our different subsidiaries. You can find me all over Facebook at Shannon Robnett, Instagram at Shannon Robnett. Just about anywhere. It's just my first name. So if you're going to shannonrobnett.com, you're going to find it. Shannon Robnett Industries will also take you directly there.
Awesome. Well, Shannon, I can't say thanks enough for taking the time to talk today.
Darren, I appreciate the opportunity. I hope your listeners and you got something out of it.
Oh, totally. I've enjoyed it, and I've learned a lot, and hope we can do it again soon.
Look forward to it, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.